When a country is in crisis, when its currency is collapsing, inflation is out of control, and debt is piling up, two names almost always appear on the scene: the International Monetary Fund and the World Bank. To some, they are saviors. To others, they are silent trap setters. The real question is simple but uncomfortable. Are these institutions offering help, or are they laying a long-term economic trap? On the surface, the mission sounds noble. The IMF steps in to stabilize economies, offering emergency loans to countries that cannot meet their international payment obligations. The World Bank focuses on long-term development, funding projects related to infrastructure, education, healthcare, and poverty reduction. In theory, both exist to make the world more stable and more equal. But help from these institutions never comes free. IMF loans usually arrive with strict conditions. Governments are told to reduce fiscal deficits, cut subsidies, increase taxes, privatize state-owned enterprises, and open markets to global competition. These conditions are often described as necessary reforms. Critics call them austerity measures that hurt ordinary people first. Imagine a country where fuel and food are subsidized to keep life affordable. When an IMF program begins, those subsidies are often removed to reduce government spending. Prices rise overnight, transport becomes expensive, food costs jump, wages don't rise at the same speed. The economy may look healthier on paper, but daily life becomes harder for millions. So the question arises, is economic stability worth social pain? Supporters argue that without these reforms, the economy would collapse completely. They say IMF programs restore investor confidence, stabilize currencies, and prevent total financial chaos. From this perspective, short-term pain is the price for long-term gain. Countries are forced to fix deep structural problems that local politicians often avoid for years. The World Bank operates differently but raises similar concerns. Its loans are often project-based: roads, dams, power plants, schools. These projects can absolutely bring development. However, they also increase national debt. If projects fail, are delayed, or do not generate expected economic returns, the country is still responsible for repayment. Debt remains, development may not. Another major criticism is loss of sovereignty. When a country accepts IMF or World Bank assistance, it also accepts external influence over its economic decisions. Budget priorities, welfare policies, and even labor laws can be shaped by loan conditions. For developing nations, this can feel like economic control without political representation. There is also the debt trap argument. Countries borrow to fix crises, but harsh conditions slow growth and reduce public spending. Growth remains weak, revenue stays low. To repay old loans, new loans are taken. Over time, debt becomes permanent. Instead of escaping crisis, the country becomes dependent on international lenders. But blaming only these institutions is too easy. Many countries approach the IMF or World Bank after years of corruption, mismanagement, and unsustainable policies. Loans do not create the problem, they respond to it. Without internal reform, no amount of external help can truly fix an economy. In that sense, IMF and World Bank programs often expose problems rather than create them. There are also success stories. Some countries used IMF programs to stabilize inflation, rebuild reserves, and return to growth. World Bank-funded projects have improved access to clean water, education, and electricity in many regions. The outcomes depend heavily on how funds are used and how reforms are implemented. So are the IMF and World Bank a lifeline or a trap? The honest answer is they can be both. They offer financial oxygen to economies on the edge of collapse, but that oxygen comes with strings, and if handled poorly, those strings can tighten into a noose. These institutions are tools. In responsible hands, they can support recovery. In weak systems, they can deepen dependency. In the end, the real danger is not the loan itself, but blind reliance on external rescue without internal accountability. Help can save you from drowning, but if you never learn how to swim, you will always be one wave away from sinking again.